All right, we're on chapter 6. Let's keep pushing through. We're going to talk about the dual tranche structure. We talked about this a little bit before. Remember, this concept that I like to call the stack, or just this waterfall of how returns are dispersed, right? So who gets their money first? Well, we know, first of all, what's the scenario? Well, you take out a loan to buy a property. The bank is going to get paid first, obviously. Easy there. Then, in a dual tranche structure, there is the presence of this preferred equity. Now, don't get this confused with preferred return, right? Let's just go through the stack first. Stay with me. The bank gets paid, then preferred equity. These guys have a fixed rate. So say you're getting 30% returns on this investment. The bank gets paid back. They just get paid back their standard percentage. We know how much the bank gets paid. That's all within the loan AM. And their rates, they might be fixed or adjustable. The preferred equity, they get paid a fixed amount. So they get paid back first. So if you only get an 8% return, these guys are the only guys getting paid back. The other folks are going to get a lot of their money back as well. But these guys are going to get their extra money back first. It's not like the LPs are going to lose all their money in a scenario where this thing only performs at 8%. Now, the preferred return gets their money back first, but if it gets to 30%, they're not going to get any more. It is a fixed capped number. That's it. And so that extra 21%, where does that go? Well, it goes down to the next level of the waterfall, which is split between GPs and LPs. Now, there's some interesting concepts here, because at first you would say, oh, wow, there's an extra 21%. Where does that go? Well, it actually does help the LPs, the folks investing in these syndications. But the GPs can sometimes do worse, surprisingly, and that has to do with these types of deals. Now, what is a type of deal where you would consider doing something like this? Well, one, you might, remember we talked about this before. We talked about with banks, you want to try to negotiate with them. With investors, you want to do what's right, because your investors are gold, and everybody does. If you do well and your investors do well, everybody does well. So with investors, you want to do what's right, and you want to know your customer. What does that mean? Well, your customer, the investor, some of them might want to sit as preferred equity. They don't necessarily want these big IRR returns that some LPs would want. I personally don't need a bunch of cash on cash for most of my investments. I'm not currently using my passive real estate investments for cash flow. I'm using them for long-term growth. I have other sources of cash flow. So for me, I would much prefer a higher IRR and zero cash flow. I really, truly don't care that much about it. So, but that's not how everybody is. Some people may want simple, lower risk and guaranteed returns, guaranteed-ish returns of 9%, and they'll forgo that extra 21% that they would be getting would the deal be at 30. These LPs here will get that extra. It's very nice. But in some deals, you might not cash flow really well for year 1, 2, 3. Think about a self-storage deal where you hit your stabilized numbers 3, 4, 5. 5 years is a little long, but it might take 3 years to lease up the facility. So these years here, 1 and 2, you might not cash flow well. And in those years, who gets paid back first? First these guys, then the LPs with their preferred return, and then the GPs. But imagine these years, you're not hitting your numbers well. Well, the GP is getting 0% during those years because you're not hitting those numbers just yet. So remember, there's 2 ways that you exit as an investor. Now, this term exit typically refers to an investment, and then how do you get your money back, right? In the stock market, the exit is you just sell the stock and you get cash, right? In a startup company, if you're an angel investor, there's a couple potential exits. The company might get bought out. You invest in Google, when it first starts or whatever, they might get bought out by another company. That didn't happen to Google. They might also have an IPO and go public. And then you just have the stock and you can sell the stock if you so choose. For passive real estate syndications, the exits are typically the self-storage facility might get a refi, right? So we build at Lantern Light Capital, we build self-storage facilities. So we'll build them on year one. The deal we're working on right now, it's a $1.6 million, one of our smaller deals, $1.6 million deal. It is a ground-up development build, all in. It's going to cost us that. And based on our underwriting, we think that this is going to be worth $3.2 million in 3 to 5 years. Now, those numbers you can adjust. You never know what the market's going to do, but we think it's going to be worth right about there. So what will we most likely do when this thing's worth $3.2 million? Well, we could sell it, but I don't want to sell it. I like my self-storage facilities. Also, that's our investment strategy. So what I'll do is to draw out some of that cash, I will refi. So I have a loan that'll probably be paid. Well, this was the total price by year 5. Let's say we'll have owed. We did have a down payment and everything. So let's just say by year 5 we owe $1.2 million. Okay, so that means we have $2 million in equity built into that deal. So then I'll go to the bank. I'll say, okay, I'd like to pull out some of that equity. Basically, is what you're saying. And we're going to increase our loan, our mortgage, to $2.2 million. That means I'll pull out $1 million in cash. Boom, there you go. I don't get taxed on that. Excellent. And I refi, and now I have $1 million in cash. Of course, my monthly debt service is going to go up. So be it. That's a exit. You can also sell your self-storage facility. Those are the two main exits. So what we're getting at here is that these are very important, this concept of cash flow versus the sale/refi. And cash flow is just the money you make as the facility operates. And as an investor, I use the term exit, if you will. And in general, when you say an exit, you're referring to your sale and refi. But in a way, you could kind of stretch the definition, or however you want to look at it. Cash flow is an exit of sorts, right? And again, the point of all of these lectures, I keep saying this, it's to discuss the semantics and have you understand it and kind of tell you how I internalize these concepts. Right? Like the concept of an exit. Yes, strictly an exit means a sale or refi, or I guess going public. It'd be nice if I had enough storage facilities to go public. Woo, yeah, Lantern Light Capital going public. But in a way, cash flow is also, for an LP, cash flow is a form of an exit, right? Because you're getting your investment back. That is a type of an exit. So going through that, remember our stack, bank, preferred, which is fixed, and then your common equity, which consists of your LPs and your GPs. Now, let's keep going. In this chapter, they also mention this concept of leverage. And you know what? We'll go through one more thing. Semantics again. And the goal here of this entire lecture series is so that investors can't gish gallop you. Gish gallop is this term within within debate. It's like an argumentation style where you just make a bunch of arguments all at once and you don't give the other person a chance to respond. I don't want GPs to gish gallop you guys as LPs, as investors. And as a GP, I don't want you to use all this verbiage. And yeah, dual tranche sounds really nice. I love that term. And okay, feel free to use it, but don't just rattle off these terms. And this comes, there we go again, bragging about being a doctor. My apologies, but let's just say I take it personally when I hear doctors talking to patients. I will see them, and I consider myself very good at patient communication. I'll see other doctors communicating to patients, and they're just and I just see the patient's face, and I'm like, that guy has no idea what you're saying. How can you not tell? How can you not tell that patient is just sitting there staring at you, too scared to say that they don't know what you're saying, because you're saying simple stuff. Half the stuff we say in medicine isn't that complex. It's just a lot of verbiage. And that, again, is really what I'm trying to do here. So let's go over this term, the sponsor promote. Sponsor. What does that mean? Yeah, so, we have a sponsor promote of like 10%. Oh, geez. Okay. It's basically just the returns that the sponsor gets. That's it. How much money the sponsor gets after you hit a certain threshold, right? So remember, within the stack, there's that preferred return, and then, of course, that pref equity as well. And then once you hit those levels, you get the sponsor promote, aka the sponsor returns once you hit a certain leverage, or once you hit a certain threshold. Nice. You'll also hear this concept of positive and negative leverage, basically saying positive leverage is this concept where if you borrow, performance improves. And typically that's related to if your the percentage that you're paying for your loan is less than the cap rate, then it's in your best interest to borrow. If you read it online or look at some of these textbooks, they discuss this positive and negative leverage in a couple different ways. They use the mortgage constant. This book mentions quite simply just the cap rate versus your percentage that you're paying for your mortgage. But basically it's kind of saying like, well, is it good or bad to buy the facility cash, or would you like to take out a loan? And if you are getting great returns, if your cap rate is high, and please watch my video on cap rate, because saying they have a high cap rate is kind of the same as saying that, you're getting good cash flow in a facility. And that's a big long rant. But if your facility is cash flowing really, really well, then you can tolerate a higher loan percentage. And as long as you're cash flowing really, really well, and your loan amount your loan percentage isn't too high, it's better to actually use that cash, to get more of a loan. You want to take out more of a loan. That's positive leverage, where using leverage improves your performance. We'll also hear this concept, the yield on cost. So where is that relevant? Well, that gets into these two things, right? The cash flow and the return on sale. So remember this facility right here? This facility, we were building it and leasing it up in years 1, 2, and 3. And then 4 and 5, it's stabilized. Well, the yield on cost is the NOI over the total project cost. Now, you can talk about the stabilized NOI, right? Because initially, that number, the NOI, which is basically your profit over your cost, your total project cost, initially that number is going to be kind of crummy, right? Because your profit in year 1, 2, 3 are going to be very low. So you'll hear people say, oh, hey, the stabilized yield on cost for year, say 4 or 5 is whatever. And with this facility, again, your ultimate goal, and I'm going to bring this home here, so pay attention. Your ultimate goal is to optimize your yield on cost, aka a nice, good, high profit. Remember my facility that I built for $1.6 million? Well, it cash flows really, really well, and it cost not too much. Why do you care about this? Because when it comes to these kind of setups, pref equity, and then whether you use a dual tranche setup or not, if a facility is not cash flowing very well in the beginning, it can be worse for a GP, worse for me, basically. But sometimes you have to make it worse for you, because there might be folks out there that want preferred equity. That's kind of that entire big long rant. So let's go into some examples and kind of sum this up, because this is like a lot of stuff, right? So in sum, Common equity in a dual tranche setup, in that setup where you have the preferred equity up top and then the LPs are just getting they're below it on the waterfall. Remember, they still have a preferred return. In this, there's lower cash flow but a higher IRR for LPs. That's what I like. As an LP, I do not want to hold preferred equity. I don't want my 9% guaranteed. I want higher risk stuff because if I'm participating as an LP, I know the guys and I trust them very well and I trust their underwriting. So I'm worth risking a little more to be an LP. Alternatively, some people might want those stabilized 9% returns that are lower risk than being an LP on one of these dual tranche setup deals. So in the dual tranche setup deal, the common equity, aka the LPs, often get a lower cash flow but a higher IRR. That's what I said. Know your investors. Regarding the cash flow, we talked about this a little bit before. GPs don't do as well with a dual tranche setup sometimes, especially if you're buying a facility that requires that year. Can you even see this anymore, or is it just me scribbling? That require that initial lower cash flow lease up. So don't just think that initially that a dual tranche setup is necessarily better for the GP, for me, because it's actually not. That's what I go over here. Now, what is a way to mitigate that kind of issue in a dual tranche setup as a GP? Well, you might hear, one sec. You might hear something called an IRR hurdle. Wow. Well, what does that mean? Well, imagine that, remember, for a dual tranche setup, it might be worse for me. I might perform worse because of the risk of not getting cash flow in the beginning during the cash flow part. And then, of course, the sale / refi. Think about again, we'll go back to my facility. 1, 3, erase that so it looks nice. 1, 2, 3, 4, 5. I'm getting very low cash flow, low cash here. But then my return here on sale and refi is going to be huge. But I don't get to reap those benefits as a GP. Kind of crummy, right? So what I might choose to do is put what's called an IRR hurdle. Basically, if we hit, so remember, those LPs get their returns here, but if we hit something over, say, 15%, if we're really doing well, instead of me as a GP only getting below 15%, I split the returns 80-20, whatever, with the LPs. But after 15%, after I've really crushed it for my LPs, I go from 80-20 to 50-50 LP / GP. Okay, so if I really crush the deal as a GP, I get extra on top. And that's cool for everybody, right? Because it incentivizes the GP to do really, really well. And that's what you want. You want a GP, we'll get into that here. You want a GP that wants to do well. You know what? I'm not going to go through actually, I will. Let me go through this. I'll go through this quickly. Let's look at some of the specifics here. So we'll go through a traditional setup and then a dual tranche setup. So traditional setup. And actually, you know what? Pay close attention. This is very, very good. These are the exact, you know what? Why did I say we'll skip through it? I think it's because it's turned into a long video. It's a tough one. I know. But really pay attention, because this is actually what you're going to hear when you watch these pitch videos and talk to these investors. So pay the F attention. All right, so scenario 1. Whoops. Ooh, can we write with another pen? Oh, fancy. That's a dual tranche pen right there. Oh, boy, howdy. So scenario 1. Scenario. I hate that pen. Okay, we're going back to a normal pen. Where's my normal pen here? Okay. Scenario 1. That's a pencil. Jeez. really, I like this marker. Okay, scenario 1 is traditional, trad. Okay, so in that, you might see the following. The sponsor, aka me, I get a 2% acquisition fee. I get a 2% a management fee. Okay. I mean, again, you got to like pay yourself. You get a 8% preferred return. Now remember, there's just standard LPs on this deal. So that's that standard preferred return. That's not preferred equity. That's not your fixed. And the GP, aka me, gets a 30% promote. And what's that mean? Remember, promote is that fancy way of saying after this 8% is hit, we split it 70-30. LP, GP. Right? That's that promote. So after that 8, let's say you go to 20% returns. That's an extra what? 20 minus 8 equals... That's 12%. Of that 12%, it's split 70-30. So 30% of that goes to the GP, and then 70% goes to the LP. That's a standard. That's it. Standard. Now, let's look at the dual tranche. So in this scenario 2, we are going to set it up as followed. 10% preferred equity that makes up 50% of the equity. Does that make sense? Because remember, with scenario 1, it was 100% was just standard LP equity, common equity. In scenario 2, we're doing 50% preferred, and they're set at a 10% rate. And that's it. That's all they ever get. Remember, that's the whole point. They're on the top of the waterfall, and they only get 10%. 50% is preferred, and then, of course, the other 50% is just, standard common equity. And we're just going to set them at 8%. Remember, they still get their preferred return. They get paid before me, before the GP. These guys get paid first, 10%. Above that, they don't get nothing. Common equity, aka LPs, make up the other 50% of that down payment, basically. That when you say equity, it's kind of 50% of the equity. That's, the down payment is your equity, right? If you buy a $10 million facility and you need $3 million down, on day one, how much equity do you have built in? You have, the loan was $7 million, and you have $3 million in equity built in. So 50% of the equity was to the LPs. So let's see how that goes. Again, the 2% acquisition fee, right? 2% management fee, that 8% preferred return. We already said that. That's the same, unchanged. And let's do the 30% promote. So let's see how that plays out. Now, in scenario 1, here's what the LP gets. The LP would get, scenario 1 was our standard scenario with just standard LP equity. We'll say scenario 1 and scenario 2. In scenario 1, LP gets 13.9 IRR and 8.4% cash on cash over 5 years. A little bit light of returns, right? GP. That is a little bit light. 13.9%, but the cash on cash is good. That you're getting that cash. That's what cash on cash is. It is like the actual cash you're getting. And the GP gets their acquisition fee, okay, of $260K. All right, that won't change for the next deal, right? We'll just say ditto because the acquisition, those fees don't matter. And then the promote upon sale is $954K. All right, this is a big deal. I forget how much I set these numbers, or this is from the book, how much he set the total deal price was. But it was a big deal. Now, what about scenario 2? Let's look at scenario 2. Well, there's multiple players, right? There's the pref equity. What are they getting? Well, that's very straightforward. They're just, you know what they're getting. They're getting 10%. That's the very definition of the pref equity. So they get a fixed percent. And this, I forget what these returns were. You got like 30% returns or some very high. Where's our, let's see, IRR 17. So 17%. Or like overall, the whole thing got 20% or something like that. Like good, solid rates. So this thing definitely hit this 10% number. Boom, good. Then we have to talk about the LPs, right? The LPs got 17.1% IRR. Ooh, way better, right? And then cash on cash, 5%. So much lower, okay? So the preferred equity, we always know what they're getting. The cash on cash is lower because they had to pay the preferred equity first, that 10%. And then the IRR is higher, remember? Because above that 10%, all that money went to the LP. So what would I like as an LP? I wouldn't mind, I like all kinds of deals, but I would prefer this, assuming it's a deal that I believe in. If I don't fully believe in the deal, I guess I don't necessarily want this preferred equity hanging above my head. Because if it doesn't do well, these guys get paid first. And then what's the GP do? The GP in this scenario still gets his acquisition fee, right? We said that was still $260. We did the ditto there, but he's not going to get as much. His return is going to be less. His promote is going to be $681K. And that has to do with that cash flow issue. In the beginning, the cash flow is going up here to that preferred equity, and that preferred return to the LP is a cumulative thing. All of that basically filters down and makes it so that the GP does not do as well in this dual tranche setup. Now, a little kind of hint. Why would a GP want to do this setup? Well, one, sometimes you got to know your customer, right? There's people out there that want to do preferred equity. And so me as a GP, I would definitely consider doing this. I'm not against it. Even if I make less, I still might want to do the deal. And I have a big group of investors and they want stabilized, safer returns. So fine. Alternatively, the investor might not believe in the deal. So remember, by having this structure, you can target higher IRRs. Now remember, this investor, the GP, me, is pitching you and trying to show you these high IRRs. And maybe, though, he doesn't fully believe in the deal, or they're not going to manage it completely well, and they're just trying to pitch these higher IRRs. They know the deal's not going to do perfect. They actually suspect the deal will do much better, or the deal will just kind of do, it'll do okay, you'll make your money, but they don't see it being this great thing. What they care more about is their fees. They're going to make money off of fees. So they could be fee focused and care more about fees. So what could you do to tease out with an investor whether they're just kind of doing this for the fees and they just want to get the deal done and they aren't going to manage it that well, stuff like that. And of course, not everything is this straightforward. It can be on the back of their mind. You could ask the GP the following. You'd say, well, hey, I know your acquisition fee is 2%, but would you be willing to do this? I'll give you a hurdle. Remember, the hurdle is where after a certain percentage, say you can give them a really good hurdle. After a 10% IRR, we were at 8%, right? Then we do the 70-30 split. Their promote is 30. The GP promote is 30. After the 8%, so from 8 to 10, we do 70-30 promote. And then above 10, I'll do a 50% promote. Woo! Wow, that's a good deal for me as a GP. I'll take that. I'll definitely take that. especially if it only means giving up my little 130K, half of my acquisition fee. Oh, will you drop your acquisition fee from 2% to 1%? And then we'll give you a hurdle. So this is you as an LP telling me, hey, can you drop your fee to 1%? And in turn, I'll give you a little bit of a hurdle, which is good for the GP, right? But maybe the GP doesn't think he can hit even that 10%. And in that case, he might push back, say, no, I need my fee. I need it. Alternatively, he might actually need the fee. So just kind of a little concept there. One way to kind of tease out whether your GP is very, very fee focused. Again, Lantern Light Capital, shameless plug, baby. I got the videos here. Come negotiate with us. Come talk to us. That's what we do, baby. We love it. Oh, God, let's sit on the whiteboard. You want me to pitch you? You want me to show you the deals? I mean, geez, buy me a energy drink or something before you do. But that's why this content is out here. That's why I'm frantically scribbling on this whiteboard, is to educate you guys and just, I don't know, I love this stuff. I think it's great. Go out there, grill your GPs, have fun with them, send them my video, have them talk trash about me. It is what it is. Last little thing, remember this senior subordinate structure is a tad riskier for the common equity. We touched on this before. The waterfall, the stack is a little bit pref equity, common, which is LP, GP, is a little bit riskier for this guy because remember, the preferred gets paid first. Bank really gets paid first. They get paid zeroth. What's the little part for zero? First, second. Is there one of those for zero? I don't think so. Zeroth. But yeah, it's a little more risky, but the returns are higher. I am, as an LP and a GP, I'm okay with this, and it gets to knowing your investor. So, I mean, every deal is different, and a good GP can sit and they can tell you why they did a dual tranche or why they did a single tranche. I don't even know if it's called that. Why they didn't do it. Why they didn't do a dual tranche. They'll sit and they'll talk to you about all this stuff. That's what a good GP does. Hopefully, you got through this lecture. Chapter 6, go buy the damn book. It's a great book. Rob Beardsley, Structuring and Raising Debt and Equity for Real Estate. I'm going through this book, reviewing it. I mean, the guys, I absolutely love Rob's commentary in there. Just listen to it. You watch these videos, you listen to the book, you will know more than legitimately 98% of passive real estate investors out there. Absolutely. This is Capper from Lantern Light Capital. Jordan at lanternlightcap.com. Wishing you guys the very best.